bonjour et bienvenue au cas de fiscalité. Préférez-vous les instructions en anglais? Do you prefer the instructions in English?
Yes.
Yes, please.
Each team has 20 minutes to present its case to the judges. The time is indicated on the timer as a countdown. I will also indicate the time remaining with posters. If you do not end your presentation after 20 minutes, it will be stopped to move on to the period of questions. A period of questions of a maximum duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind each judge that it's mandatory to ask at least one question during this period. Please note that you cannot reveal the name or source of your university, as you may be disqualified. I would like to ask the public to turn off the ringing of their cell phone. I will now invite the judges to introduce themselves. Je vais maintenant laisser les juges se présenter et ensuite vous pouvez laisser votre présentation.
Fernand Loisel, directeur régional pour IG Gestion Patrimoine, Bureau de Montréal, Centre-Ville.
Julie Racine, coprésidente du comité des jeunes fiscalistes de la Fondation canadienne de fiscalité.
Bonjour, Karine Boucher, directrice en fiscalité chez le Minolet.
Bonjour, Marc Doiron, associé en fiscalité chez le Minolet.
Alexandre Schmidt, directeur de division pour IG Gestion de patrimoine à Moncton.
Michael Bilodeau, je suis directeur régional au bureau de Lévis pour IG Gestion de patrimoine.
Bonjour, Martin Diane, directeur régional de la Chine pour IG Gestion de patrimoine.
Bonjour.
Enchanté à tous, on va commencer. So, the smartest man in the world once said that the hardest thing to understand is income tax. Well, that's why we're here today, my teammates Tiziana and Vincent, and myself, Eloise, to address your concern and hopefully answer all of your questions. So, our mandate here today was to offer financial and tax planning services to you, Monsieur Bergeron, with respect to your clinic and your future retirement. So, we're going to go through corporate tax, estate planning, and other consideration, and that's how we're going to go through all the questions you asked for us today. So your questions were if you're adequately organized to retire, if you have enough money to retire, if you should proceed to sell your business, and what are the estimated tax for 2018 for yourself. So let's start with the corporate tax. I'll pass it out to Vincent.
Thank you. So now let's start. Basically, the most important thing to start is to differentiate the fact that accounting income, net income, is completely different than taxable income. Accounting income follows GAAP, whereas taxable income follows the Income Tax Act, which is really important. Based on the the income statement that you provided to us, these are a few items that you had deducted. There was net differences that we had to deduct going forward, and that's what the net effect was. And also you mentioned that you only offer you only recognize the revenues once they've been delivered. For tax purposes, just keep in mind there was not enough information in your specific case today, but just keep in mind that undelivered services, you have to claim a reserve. You have to claim a reserve in the current year, and then next year you add back that prior year reserve and deduct the current year reserve for undelivered services. So if we add up everything, your net income for tax purposes, which in tax lingo would be Division B, would be around $600,000. With your Division C deductions, based on the information you gave us, you had absolutely nothing. So the Division D was equal to the Division C, and that added a difference in net tax payable of $64,000 in 2018. The really important distinction was the fact that based on the balance sheets that you gave us, there was a large, significant investment in a GIC and no investment income, including your financial statements. So that was one net distinction, and that's the additional refundable tax that we had to add to the actual taxes, in addition to the other reconciling items that we found out. So basically, one other important factor was, based on the balance sheet, you had corporate tax payable that was still outstanding from prior years. One important thing is that for corporations, all corporations in Canada, 90 days after your year end is when you have to remit the proper taxes to the authorities, and if not, interest and penalties accrue from that on a daily basis from that point forward. So make certain that the key takeaway would be to pay your taxes as quickly as possible and to avoid as many interest and penalties, even though you might have to pay some on the already outstanding balance. So basically, now for estate planning, the first important thing to do in any tax situation is to determine whether or not your company is a QSBC and if you're eligible for the lifetime capital gain deduction on your eventual disposition of your shares. 4 criteria. The 3 first are usually met. The last one is more complicated. In this situation, actually, you aren't meeting the 90% at time of sale because you're only at 67%. These were the active assets. These were the total fair market value of the assets on your balance sheet. So that means you don't meet it right now. So purification, you have to do purification before you can actually move forward with any thinking of selling your shares. So how do you do this? There's 3 basically common alternatives for you. If you have enough cash to pay dividends out to your shareholders, the best way is the CDA, the capital dividends account, because it's tax-free proceeds to your shareholders. Then there's the general rate income pool and the RDTUH, but in this situation you didn't have enough sufficient funds. The butterfly reorganization, which is a complex transaction, but it basically allows you to extract a specific investment from your holding company, but it's really complex. And in this situation, you can also sell to an external party. And since the actual investments was a GIC, it doesn't accrue much value. So even selling it to an external party, the real problem is to have immediate tax consequences. But since there's no accrual of growth, there won't be that many tax consequences on the disposal. So now I'll leave it on to my lovely colleague Tatiana to go over the rest of the estate plan.
Alright, so we've looked at your corporate taxes, and now we're going into your next section, essentially, which is what are we going to do with your current business that you have? So let's look at it on 2 perspectives. So first, your perspective, Monsieur Bergeron. You are 55, you just turned 55, oh sorry, 2 months ago, so happy belated birthday. You plan to retire in 5 years. You do have sufficient funds, you're looking for sufficient funds in order to travel and live comfortably with you and your wife. And you also want to take care of your wife should you have an unforeseen death. You'd like to make sure that she is well protected and taken care of in the future. Now, in terms of the clinic that you own, Clinique, you have 2 employees at the moment. You are the sole shareholder. And every year, your company's business has been rising 8% for the past 5 years. So this is really great for you, and we're happy that you've been able to take your corporation into growth over the past years. Which means that right now, your company's shares have a net worth of $2.4 million. So essentially, when we're looking at estate planning, we want to be able to make sure that we meet these criteria, which to us are very important. We have the utilization of lifetime capital gain deduction, which is crucial here because the government allows us to have essentially a certain amount that is tax-free, but we don't know when the government will take that out. So we want to be able to utilize that as soon as possible. We want to assure the funds for the future, again, protect your wife, and minimize immediate tax consequences. So when we're going to estate planning, these are the things we want to keep in mind. So we've kind of broken it up into 2 separate parts. The first is the sale of shares versus the sale of assets, and next is estate freeze. The first is the sale of shares and assets. This is a point that you brought up to us and asked, well, what if you get an offer for someone to come in and buy your company? So we'll look at that. And then we'll look at our option, which is an estate freeze. So first, as I said, sale of shares versus asset. We're going to look at the sale of asset first. So essentially, selling your assets just means that the assets that your corporation has, you're just selling them to a third party. So your company, Clinique, would essentially still exist, just that your assets have been sold. So what does this mean? If we look at the assets that you've provided, again, there's one thing we want to keep in mind here. We weren't able to figure out the exact fair market value. So what we did is we took the cost and we have the net total fair market value that we've just prorated. So this is something to keep in mind that we would like to revisit this with future information. However, just to get an idea of where we're going here, the total amounts that you would have after the sale of your assets would be roughly 1.8 million. The thing that's important with the sale of assets is that your liabilities would remain in Clinique. So it means that you have to pay your liabilities. You'd also have wind-up costs. So as I said earlier, you would sell your assets, but your company still exists. So that's a cost that we have to take into account. And unfortunately, you wouldn't be eligible for your lifetime capital gain deduction here. As I said, that's something we really want to take advantage of as soon as we can. So kind of a scary slide, but essentially all I'm saying here is that we have a net total income to the corporation of $1.8 million. So this would be after liabilities, which you don't have many liabilities, so that's good for you. And after your taxes have been paid. So this is net to the corporation, not to you. Once you've paid your liabilities, once the corporation's paid its liabilities and its taxes, you would get proceeds of roughly 1.8 million minus your PUC, which would give you a deemed dividend. However, you do have CDA. It's not much, but we'd like to take advantage of it should you choose to sell your assets. So essentially, you would have 1.8, roughly just over 1.8 million. You do have a GRIP, so you would have eligible and non-eligible, which is something we could speak further of should you have any questions. Essentially, we are suggesting that you don't go this route because it does not allow, like I said, and I've been stating the importance of the lifetime capital gain, it does not allow for that. And there's high immediate tax consequences, which is something we'd like to avoid. So the second option would be the sale of the shares. So the sale of the shares, as my colleague Vincent pointed out, if you do the purification, you would be eligible for the lifetime capital gain deduction, which is, again, as I said, super important. So we would have the proceeds. Essentially, we would just be selling the shares to a third party. We would take use of the lifetime capital gain, which is just over 848,000. We've used just 848 just for simplicity purposes. We would have an inclusion rate, the tax rate, and then total proceeds of $1.4 million roughly. So you can see here you would have the utilization, again, of lifetime capital gains, less immediate tax consequences. And you did mention to us that you would want roughly $91,000 every year post-retirement in order to maintain your lifetime, your habits with you and your wife in order to live properly, which is around 70% of your current income. So this would, if you do it this way, you would get roughly $53,000 a year. Again, this is not the best solution because essentially you can take this money and invest it. So it doesn't necessarily, it's not an exact number. It's not that you will be getting this, but it's just to give you some kind of an idea that if you do it this way, this will be your proceeds. So it does not meet your 91,000. Again, keep in mind, like I said, you can always invest and figure out something else with RSPs, as my colleague will speak of shortly. However, we don't suggest this method either. So you did come to us and say, what if somebody actually goes ahead and purchases it? These would be certain considerations that we will take into account on the perspective of the buyer and the seller. So as of now, you don't actually have an offer, but should you have an offer, these are things that we want you to consider. We don't have time to go through them one by one, but if you have any questions during Q&A, we'd like to answer them. So there are certain things that you want to take into account and certain leverage you would have. So now, we've spoken about sale of shares and sale of assets. There's also a third option, which is redemption of shares. So you essentially redeem your shares and someone else would buy them. But we don't like this option, no utilization of lifetime capital gains. So we're going to skip over this as well. So we get to our recommendation, which is an estate freeze. So we know that you don't currently have an option, a buyer rather, so we suggest, if you're not in a rush, since you're looking for 5 years before retirement, we suggest you would go ahead and do an estate freeze. Right, so we have essentially an estate freeze would mean that you would incorporate a new business, which in this case would be called Holdco. And you would file an election. So you would need to fill out the form T2057 in order to be able to actually do this election. Now, what does this mean essentially? An estate freeze, what happens is that your company that you've created, Holdco, you would essentially roll over the shares of Clinique Pup into Holdco. So Holdco would have 100% common shares, direct control of Clinique Pup. In exchange, you would take from Holdco preferred shares. Now, we like this option because preferred shares allows you to have a dividend, so you can always put that in the clause for preferred shares, so you can get paid yearly to meet the 91,000 criteria. Also, your company is growing, so your children will benefit in the future. Your kids are getting older, they're graduating from school, so maybe this is an option you want to consider in that they can manage your corporation. The growth can accrue to them. Yeah, you can also make the preferred shares redeemable at your discretion. So if your kids are like running your company into the ground and you want to protect yourself, you can always go ahead and redeem your shares. And the most important thing in this situation is the utilization of your lifetime capital gain deduction through crystallization. So essentially, you would have an elective transfer price of $848,000 in order to utilize your lifetime capital gain of $848,000. So again, wife has income and it's protected in the future because you can bring your wife in as well as your children. So she will subscribe to common shares and be able to get dividends. So should anything happen to you, if your company continues to grow, she will be protected that way. Again, utilization of lifetime capital gains and no immediate tax consequences. So essentially, this is what we suggest for you to do from here on until the future. So you have enough money to retire by doing it this way, and essentially we've met all of your criteria. With that being said, I will pass it on to my colleague who's going to speak about other considerations.
So basically we went through what you need. So you want to buy a cottage, you want to pay your children's studies, you want to travel. So in the short term, you would need $411,000. However, that is not necessarily needed because you could take a mortgage on the cottage. You don't need to cash it down right now. However, we are looking with the 85 freeze to have the rest of this covered. So basically, what you asked us if it was reasonable for you to pay a salary to your children. There was a new rule of tax in 2018 on split income, which means that it's more and more difficult to do that. So for the salaries, it must be based on a reasonable fair market value of their service provided. So if they want to have a salary, basically, they have to work for your company. So if you really want to give them a salary, we recommend that you hire both children during the summer instead of them working at Starbucks after school, and you can then pay them a salary like that, and it's deductible to your corporation. So then there's those expenses. You asked us if they were deductible. The face it, unfortunately, is not. The barbecue either, because it's not going to be used for the business specifically. And as for this office expenses, there are some criteria that we can go over, but if they are met, that is definitely going to be deductible. So for the home office expenses, here are the criteria. Basically, you must prove to the CRA that they are reasonable, and that's how they're going to be deductible. If you respect them, yeah. So basically, the shareholder advances, we saw that they were both on the balance sheets for 2017 and 2018, which means that they were not paid within the 12 months after they were gotten, which means that they have to be added in the income in the year of reception, which is 2017. There's going to be no imputed interest benefit on the loan, and the increase in 2017 tax payable is going to be $33,000 plus the interest and penalties. But since, as we understood, this is the first time, you can make a voluntary disclosure to the CRA, and they will likely waive the penalty. However, you still have to pay the interest. So for the future, there's the RRSP, TFSA, and Land Series that you could do. The RRSP, basically, if you and your wife have both room in your RRSPs, you could consider a spousal RRSP, which could be really advantageous for you. So it is a tax splitting tool that is allowed, and it could reduce that taxable income for Monsieur Bergeron, since, if I'm not mistaken, your spouse is not working. So important considerations is you do not lose control. So if you split it and you divorce, it's done, it's hers. And yeah. So tax-free savings account, so a TFSA. So you can have a cumulative limit of $55,000 roughly, and any excess after-tax funds should be invested in the TFSA immediately, because it's very advantageous. And finally, the Land Theory, the FMV is $300,000. And the ACB is 50, so good job on the investment. So a sale to the external party, so you can either do that and get a capital gain. Unfortunately, it's a 33% tax. However, you could also consider negotiating with the buyer to receive the proceeds over different years, so that you could get the tax on more years. So if so, the capital gain reserves to defer the tax that are going to be available on the sale. So I'm going to pass it on to Vincent to conclude.
Perfect, thank you. So why are we here today? We are here to offer the financial planning and tax planning for yourself and your corporation and see what the best way to transfer to your children and how to, since your lifetime capital gain deduction will be utilized through our recommendation, how to have the future growth accrue to your children, which all have available lifetime capital gain deduction room. We split into the three key issues: the corporate tax, the estate planning, and the other considerations. We fixed the corporate tax issue by making certain that you complied with all the rules, and reduced by making certain that you're aware that there's interest that has to be paid and outstanding balances that has to be paid. So you're basically reducing the amount of interest and penalties you're going to have to pay on those amounts. The estate planning, by our crystallization, you're getting $848,000 that you're basically receiving, not now, but later tax, like you're basically having paid it, you're not having to pay taxes because you're eligible after our purification. And the estate freeze, the fact that it's an incorporation, so you have more flexibility on the payments. And finally, the other considerations, now that the new rule is out, you're officially aware of the tax on split income rules, and you can now know what to do in order to avoid them and avoid the highest marginal rate of taxation for your children. And the RSPs, now at least you know that it's an extremely good benefit going forward, and since you're going to have a high increase in income, making certain that doing deductions in those years could be very beneficial to you. So as Mr. Einstein said, he thought that it is the hardest thing in the world is income tax. We hope that our presentation helped you at least understand tax a little bit better. Thank you for your time.
Okay, a little question for after selling the business, what would be the best tax strategies to utilize to have more funds in the future during the retirement, except the RRSP that you already talked about?
Just let me rephrase. It's after the disposition to your...
after the disposition of the business.
Okay.
Yeah. What would be the tax strategies available to Mr. Bergeron to invest the funds coming from the sale of the business?
Since you have multiple assets, you have you can get loans and deduct the interest, and also find those. I'm sorry.
Is it an interest income or other type of income that would be more tax efficient?
Obviously, the most tax efficient way would be the taxable capital gains, having growth, because they're only 50% taxable.
Perfect.
And also, if you gift property to your children, it's also like, since there's immediate tax on the transfers, but the capital gain can be actually split to your children, so the capital gains aren't attributed also. Yeah.
Perfect. Thank you.
Quick question. So you said after the sale of shares, you would have roughly about $54,000 a year. So with your solution, how much money am I going to get for retirement? And you base my retirement until what age? 85, 90 years old? Or?
Right. So the money that we established that you would be getting per year, it's important to keep in mind that this is just a straightforward if you sell your shares. So this doesn't include, as my colleague was talking about, RSPs, TFSAs, anything else, any other investment that you might have done. So your limit was to reach 91,000. You're almost there. Hopefully the RSPs, the money you have saved up, the TFSA, and every other investment that you have, since we saw that you were an investment savvy person, will be able to meet up to the 91,000 that you've asked from us. And for the life expectancy, you are expected, according to your calculations, to live roughly 82 years old. However, there's always a discrepancy of a few years, and it should be able, with the right planning, to meet up to whatever age you and your spouse will reach.
Okay, if we sell the land, what would be your recommendation in terms of investment? Should we put the money into RSPs, TFSAs, and to the holding company? Where would you put the money?
Well, the main thing, as soon as you get the money, always public shares that pay eligible dividends always have the best tax treatment, so you can always maximize your after tax proceeds. That being said, with the funds, making certain the reserve is claimed for that transfer, and real estate is always an amazing investment going forward, and you can incorporate it and basically it's a great investment going forward. Yeah.
Thank you.
In your calculate of the income of 63K a year, did you include the investment that we can move if we in GESCO if we sold the shares?
It's the investment for the purification that we did.
Yeah.
No, we removed.
It's not included.
No.
It's not.
All right. Okay. So it's only the.
Yes.
Thank you. Sorry for my English.
Okay.
It's good.
Merci.
Thank you.